What are 10 common mistakes to avoid when short-term trading? This is what we're going to look at today, and please stay tuned because near the end I'm going to talk about how you can actually take the profits that you're making and not leave them on the table. Let's get started. This is Crypto Intel. I'm Max, your host. So the 10 top mistakes people make in short-term trading. The first is not having a trading plan. A trading plan is really a roadmap. It guides us through our trading decisions. It should include goals for trading. It should include a strategy or strategies we're going to take, risk tolerance that we have, and how we're going to exit the trade. Without a trading plan, you're more likely to make impulsive decisions. You're going to lead to losses in that way. So first, trading goals are not how much we're going to make every day or every week. That's the wrong way to look at it. It shouldn't be that specific. What we want to do is have goals that are much longer that we work towards on a daily or a weekly basis. We want to pick a strategy in our trading plan. We want to pick one strategy to start and work it, learn it, back test it, and do it until it's successful, and then go on to another strategy. A common mistake beginners make in trading is they jump from one thing to another. They think they have to do something different every day, and it's not really true. So pick a strategy, learn it, and do it. Know your entry and know your exit. Before you make any trade, and this is part of a trading plan, you should have written down, an exit, an entry, and where you're going to take profit. Decide how you're going to ladder in. In other words, are you going to put all of your trade in at once, or are you going to put a portion in over a period of maybe 1, 2, or 3 trades? And the same with getting out. You ladder out. You take a portion of your profits at a certain level, another portion at another level. And then finally, decide on an overall risk strategy for yourself. Make sure that you're taking into account your risk tolerance. So that's the first one. Second one, over trading. So what happens is it's really trading too frequently. It can lead to losses because there's commissions in trading. It can lead to slippage where you're trying to make a trade over and over again, or you want to get into a trade very quickly, and what happens is the market moves before your trade is actually made. So what you want to do is think of it this way: less is more in trading. You want to get to the point where you're making only trades that have a real good risk-benefit relationship. So why do people force trades? They do it because they're trying, number one, they may be trying to make up for losses. This is again where a trading plan and a specific entry and exit is so important. If you have a specific entry and exit and you have a good trading plan, you're not going to be tempted to want to do something different. You just follow the system. Daily quota, you're going to be more prone to over trading when you do that as well. So stick to your entry, stick to your exit, and follow the plan. Be a robot. Next, not using stop losses. So a stop loss is in order to sell. It's when the price reaches a certain point, you're going to get out of the trade. They help you to limit losses, and they prevent you from really getting out of control. It's important to always use stop. I don't make a trade unless I have a stop loss in place. Now, the stop loss doesn't have to be a physical stop loss. You can just set an alert so that you can get out of the trade at a certain point. Be careful of overnight trading too. If your trade is going to go overnight and it's close to where you might be stopped out or where you might want to get out of the trade, then you should set a physical stop loss. Okay. Next, number 4, risking too much capital. It's important to only risk a certain percentage of your capital on each trade. And what this is going to do is to help you protect your regular accounts. And it's also going to help you in terms of leverage trading. First of all, Unless you're very experienced, you should not use leverage in trading. You should only use leverage when you have what we call house money. In other words, you've made some gains, you've taken those gains out. Now you want to use a portion of those gains to do a little leverage, okay? This is something we're going to talk about further in other videos. But for now, you want to have a very clear strategy on how much capital you're going to risk for your short-term trading. My ballpark figure is about 20 to 25% of the capital you're going to trade could be for short-term trading, and the rest should be longer-term trading and investment. Do not use leverage. That's really important. Number 5, chasing losses. Chasing losses, it's really when you're in a losing position and you want to add some funds because you think it's going to go up, or you hope it's going to go up, or you hope it's going to go down, depending on the kind of trade you're doing. But it's important to cut your losses and move on to the next trade. There's always a next trade, and losses are part of the game. So this is where having a very strict trading strategy in place will help you. You won't be tempted to change what you're doing. You follow your strategy for good or for bad. Sometimes it'll work, sometimes it won't. Hopefully it'll work more than it doesn't. But either way, you're going to learn something. So the reason why people get caught in chasing losses, number one, is they don't do back testing. If you have a strategy, you need to go back in time and play with that strategy and see what it does over a period of time. I like to do 30, 40, or 50 iterations of that trading strategy so that I get a feel for what percentage is going to be successful. So the only other thing about chasing losses is sometimes folks stay too long in a trade, and that's another reason why it's good to do back testing. If you do back testing on your strategy, then you're going to be able to also get a feel for how long a trade should take when it wins and how long a trade should take when it loses. And when you do that, you're going to know that if a trade, say, goes for an hour, usually when it wins, once it goes past an hour or 2 hours, or whatever the time is, you might think of reducing your trade down or getting out of the trade. Number 6, not taking profits. And this is really important. This is why I said at the beginning, a lot of traders, especially beginner traders, don't take profits when they're supposed to. It's important to take profits. It's important not to be too greedy with your trade, wait for the perfect trade, or trying to see if it's just going to take that one step further. When you make a trade, you should have your take profit areas already outlined, and you follow them. It's very important. Ladder out, as I said before. So you might have 2 or 3 levels of a successful trade where you're going to take your profits out. You can, though, keep a small runner. If you're in say you have a trade that you want it to be long, and the market in general is going long, and your trade is very successful, you might then at that point keep a 5-10% as a runner, just in case the trade keeps on going. But the bulk of the trade, the bulk of the profits will have been already taken out. Number 7 is emotional trading, and that's really, it's important to be able to control your emotions, but the way that you do that is by sticking to your plan. Emotional trading happens when you don't have a plan in place. You need to think of yourself as a machine. And by short-term trading, we're talking about anywhere from a day or two to a few weeks, okay? You're going for a short-term gain or a short-term short, and what you want to do is keep in the back of your mind that there's always another trade. If the trade goes against you and it's time to take your loss, take it. Take it like a man and move on. Go to the next trade. We want to allow the market to direct us, not our need for money. That's why if you're trading for income, 99% of people that try that fail. The market does not allow for a consistent income, especially for beginner traders. You need to only use money you can lose. You need to have a plan and stick to it. Number 8, not following the market. Now, it's important to stay up to date with what the news and the trends are outside of the trading market. This is going to help you make an informed decision. So you need to be aware of what events can affect the market overall. So for instance, that could be a CPI number coming out, inflation numbers. It could be what the interest rates are going to be according to the FOMC, according to the Fed. It could be corporate earnings. You need to keep a track of these kinds of events because they can affect the trading for a short period of time. My advice is, especially for beginner traders, don't trade on days when there's a big announcement coming out, a big announcement about inflation or about interest rates or big companies giving earnings that could really radically affect what you're trading. Number 9 is basically giving up too easily. And that is that we don't want to, we don't want to think of trading as a short-term thing. It's a long-term game. It takes time, it takes patience to be successful. You can't give up too easily. And again, this is why you need to have a plan. If you have a trading plan and you keep a trading journal, it's going to help you to see where your mistakes are and take those incremental steps to become a good trader. And then finally, not learning from your mistakes. Everybody makes mistakes, but this is why it's very important to keep a journal, especially when you first start. I keep a journal and I've been trading for many years. You keep a journal because it helps you to see where you're kind of veering off track. And everybody veers off track every once in a while. It's just, that's human nature. Is look at what a trading journal comprises. So, basically what you want to do is have a journal that will include the day and time of the trade, what you're trading, the position size you have, your entry and exit, and whether there was a profit or loss. These are the main things you want to keep in a trade. And you can find trading journals online, but you can just make one up yourself with just a regular spreadsheet and put in these columns. Date and time, instrument trading, what you're trading, the size, the entry, the exit price, and the profit and loss. Include the reason why you're entering the trade. What in the technical analysis made you want to make the trade, or what strategy you're using if you're just focusing on one strategy. What fundamental analysis is happening at the time. And then include your stop loss, your profit levels, as well as any adjustments that you made. Finally, look at your emotional state and reflect on what happened during the trade. How did you feel? Did you get out too soon? Did you follow the plan? If you do this with every trade, you're going to become a better trader. You're going to learn how to do it, and you're going to be better than 90% of the people that try to do trading.